talk a little bit about investing basics. It's never too soon to start thinking about investing. Investing means putting your money to work, earning more money. Done wisely, it can help you meet your financial goals. Your goals might be buying a home, paying for a college education, enjoying a comfortable retirement, or whatever's important to you. Investing even a small amount has the potential to produce considerable rewards over the long term, especially if you do it regularly. But investing means you have to make decisions about how much you want to invest and where to invest it. That means you need to know what choices you have and what risks you take when you invest in different ways. There are three basic investment categories: stocks, bonds, and cash. You can invest directly in any or all of them, or indirectly by buying a mutual fund or an exchange-traded fund, an ETF. That pool with money from other people and then invested. Stock mutual funds, for example, buy stocks, while most money market funds make cash investments designed to maintain the value of each share at $1. Stocks are ownership shares that investors buy in a corporation. Cash and cash equivalent investments include money in money market mutual funds, bank accounts, certificates of deposits, CDs, and U.S. Treasury bills. Bonds are loans that investors make to corporations, governments, and agencies. Let's talk about some enormous opportunities. If you want to invest, you have a wealth of opportunities available to you. In the United States alone, there are thousands of stocks and mutual funds and millions of corporate and government bonds you can choose from. You can invest in markets around the world, in developed or emerging economies. But how do you select investments? Selecting the best investments for your portfolio depends on your financial goals and your time frame. For example, a smart investment for a long-term retirement plan may not be the best choice for college savings. In each case, you're seeking a different balance of three things: liquidity, safety, and return. Let's talk about liquidity. How accessible is your money? If your investment must be available to cover financial emergencies, you will be concerned about liquidity, or how easily it can be converted to cash without the loss of value. Money market funds and savings accounts are very liquid. But if you're investing for longer-term goals, liquidity is not as much of an issue. What's more important is increasing the value of your portfolio so that it can provide future income and perhaps assets to leave to family, friends, or charities. Safety. What's the risk involved? Investing means taking some risks. To many people, the biggest risk is losing money, so they look for investments they consider safe. Usually that means putting money into bank deposits or U.S. Treasuries. The opposite, but equally important risk, is that your investments will not provide enough growth or income to offset the impact of inflation, which is the gradual an increase in the cost of living. One solution may be choosing a variety of investments with different levels of risk to provide both safety and growth. And finally, return. What can you expect to get back on your investment? Relatively safe investments often promise a specific, though limited, return. Those that involve more risk offer the opportunity to make, or lose, more money. Let's talk about other investments. You can find many other things to invest in, such as real estate or private partnerships if you're looking for more variety or can afford to take added risks. But we at 1900 Wealth believe that the three basics, stocks, bonds, and cash, should be the core of any investment portfolio. High on the list of reasons for that advice are the easy-to-understand structures and the regulatory requirements that govern these types of investments. In addition, if you need to liquidate your assets quickly, you can sell these investments easily, although you may not necessarily sell at a profit. Selling other types of investments may be slower or more difficult. Let's talk about ways to invest. Just as there are different types of investments, there are different types of investment accounts. You can put as much money as you wish in a taxable account each year and choose from a full menu of investments. You do pay tax on any earnings your investments produce and on any gain in value you realize for selling an investment for more than what you paid for it. There are qualified dividends and long-term capital gains, which are taxed at a lower rate than your regular income. You can also have one or more tax-deferred retirement accounts. You can postpone taxes on investment earnings in a tax-deferred account until you withdraw them. In some accounts, you can also defer taxes on the amounts you invest. When you do withdraw, the tax that's due is figured at the same rate as you pay on other income. There are some limitations though. The annual investment is often capped, and in some plans the investment menu may be limited. You may also owe a penalty if you withdraw early, which is usually before age 59 and a half.